recipes for technical trading success in Cook's Kitchen.
Do you know how your investing is being disrupted constantly? I bet you don't. Today, I'm going to shoot an arrow right through a group of people, including institutional investors, retail investors, millennials, and even day traders. Let's get started. All right, first of all, I'm pivoting off of an article this morning from the excellent Michael Santoli on CNBC. He says, these stocks should be booming during this historic bull market, but instead some are down 40%. I'll just read to you here. He's talking about the stocks of the investment managers like Blackrock, Franklin, T. Rowe Price, Legg Mason, Invesco. The stocks are down 25%. And he goes into, he tries to explain it, talks to a few people, and we find out that, you know, you might think, oh, maybe the end of the bull market is near, and that's why the asset managers are not doing well. Au contraire. He points out a few converging trends. One is the one that's been with us for a while, ever since Vanguard and John Bogle, and that's low-cost index funds. And they tend to dominate the collection of new cash from investors over active strategies. The second thing, you've got the financial supermarkets such as Schwab or software-driven robo-advisors. We're going to talk about some of the robo-advisors in a minute. And then if the active managers are not keeping up with the S&P 500, underperforming the benchmark, what does that create? It hurts the outlook for the revival of interest in stock-picking funds. Again, this is all from Michael Santoli at CNBC. All right. I have a podcast, if you don't know. It's called Mind Over Money. I haven't done an episode in a while, but I have a lot of good stuff in the archives. I try and do stuff that has a long shelf life, and you can always go back to it. And I did a couple of podcasts on the next evolution of technology disrupting Wall Street. And that we're talking, of course, about firms like Betterment, Wealthfront, Acorns, and a firm you may not have heard of called Plum. Let's take a look at my episodes from my podcast. In November of 2017, I did an episode called Deep Learning Goes to Wall Street. FinTech innovations are changing investing tools and behavior in powerful ways that you must begin to explore. In the next month, in December, because I introduced Plum in that November podcast, I had the CEO on. Gaurav Chakravorty is the founder and CIO of Plum. And he's using AI to actively manage funds. So this is a combination here. And I just want to read my my tagline for that episode. How will artificial intelligence change your investing? AI is not a replacement for stock picking, but it will become a powerful ally against bad decision making. And that's the thing that really interests me, is that I'm obsessed with the behavior gap, which in finance we're talking about. People think they know what to do. They hear good rules for investing or trading, but they don't follow them. They don't know how to be systematic. They don't know how to be disciplined and follow rules. So, and what Plum has done is it's brought together active management with an AI strategy that sort of takes the manager out of it. They crunch a lot of historical data and came up with formulas based on macro, the economy, and then based on trading and sectors. And I think primarily they use ETFs right now. But go back to that episode where I interview him, and you'll learn all about their strategies. Obviously, you can go on their website, Plum. They've made some good changes recently, I think. So that, and you can find my podcast, Mind Over Money, on iTunes, of course, or on Zacks.com on the podcast page. And again, that episode, How Artificial Intelligence Will Change Your Investing, from December of 2017. All right, moving along. Oh, I wanted to show you here real quick on the Plum site, a couple of recent educational articles. I thought this was interesting. They have alliances with several brokers. Now they are bringing Fidelity into the fold, which I think is interesting. More money from Fidelity could go into the Plum option for active AI management. And this other article from September 7th, Capital Preservation, How Plum Aims to Protect Your Wealth. They're using the falling dominoes, and the guy sticks his hand in between the falling dominoes. That's because Chakravorty, his whole thing with creating AI is let's stop the downturns, or let's prevent catastrophic losses from the turn in the market. And that's what he's all about, is capital preservation when either economic or technical trends tell him the market is turning, or tell his AI that the market is turning based on many factors. Then they get you out of the market, but they can just as quickly get you back in. All right. Speaking of Acorns, Betterment, and Wealthfront, I talked about those in my first podcast from last November, but here's a great, if you want to compare them, this guy, his name is Andrew Fibert, and he's got a blog and a podcast he's been doing since, I think, 2013. He just published this last week, September 24th. Acorns versus Betterment versus Wealthfront, epic robo-advisor battle. Find his article. Note over here on the right-hand side, he says advertising disclosure. He does have links for all the firms. He does have sign-up buttons for all the firms. So he's got some kind of disclosure, and so you should know about that. But he does a great job of comparing them head-to-head on several things, just like you would want to see, if you were picking a broker. And this is a new type of investment animal. But, where do millennials come in? Millennials are using these. And I think the assets under management right now, Betterment leads the fold with $5 billion. Wealthfront has about $3.5 billion. And Acorns is only about $75 million. So just to give you an idea of how money's going into those. But again, it's alternative. And it's attracting capital. All right. Speaking of alternative, let's talk about factor investing and bring in the institutions here. This is a report from Blackrock. I can't remember exactly what month this was published, but it's about a 15-page report. They look at the factor investing landscape. But here's the number that stands out: 1.9 trillion assets under management right now, and they see it growing to over 3 trillion. What's going on there? Let's take a look. So factor investing can have a macro filters, quantifying all the macro things you can think of, the economy, interest rates, inflation, bonds, you name it. But then you can quantify investing styles, value, momentum, size, growth, quality, all kinds of things. All right. Here are the 3 major forms of factor investing according to BlackRock. Obviously, you can pause the video and take a look at this, but you've heard of some of these. Smart beta, it's rules-based index exposure. Proprietary factors is more actively managed. And then enhanced factors, I think, goes beyond that to more sophisticated strategies that Wall Street has been using for a while. But here's the deal. If there's 1.9 trillion in these funds now, where did it come from? Here's my theory, and I bet you I could prove this if I look deep enough into it. It's institutions who have money they've got to put to work, and they're not sure. So, hey, let's plunk some in this quantitative strategy, that factor strategy. Even active managers could have that option, especially if they're not beating the market. With a factor-based quantitative investment strategy, maybe they can keep up with the market with some of their new cash. All right, so money is going into these strategies, and it's causing something else to happen. Well, I'll tell you what that thing is, but here's the projection from BlackRock. So you can see 2017 there in the middle, 1.9 trillion. By 2020, they project 2.7 trillion. By 2022, 4 years, almost $3.5 trillion in your factor investing, your smart beta, other factors. But remember, they're all quantitatively driven, right? There's no managers making discretionary decisions. And this is a big trend for money because there are trillions of dollars that still come into the market, right? And it needs to go somewhere. And it's going less to the active managers. All right. So where am I headed with this? This is one of the causes of the market continuing to climb higher. That money, we know about passive indexing, which drives money into the market. But now there are new forms of passive indexing with the whole factor stuff. Now I didn't know how big, really, when I looked into it, I didn't know how big this factor trend was. 1.9 trillion, it's going to grow by over 50% over the next few years. So that tells you that this is another form of basically passive indexing, and especially because it's got that quantitative appeal, right? Take the person out of it, just show me the strategy. This goes back to one of my #1 secret of Wall Street. I've written a version of this article for at least going back to 2010 called 5 Secrets of Wall Street. The #1 secret of Wall Street is they have to buy. So you can find this anywhere, but just by typing in 5 Secrets of Wall Street, it's all over the web. I've written several versions of it, but they all have the same 5 rules. The number 2 rule is they don't have to sell. So think about those 2 rules when it comes to institutions that have money coming into them where the dollars are earmarked for stocks. #1, they have to buy. #2, they don't have to sell in a downturn. So that keeps the market moving higher. All right. Now let's talk about traders. Okay, so I said I would bring in traders. Technology is changing everything, right? It's changing investing and will continue to do so, but we can find ways to benefit from it. Now, I used to be a very heavy technical trader, and then I became somewhat more fundamental and try and blend the two. But one thing I try and do is help technical traders avoid the randomness. And one of the worst things you can do, I've written an article of the 5 big myths of technical analysis. One of the worst things you can do is use hard trend lines, using a linear system on a multidimensional, complex, nonlinear, chaotic system. All right, and so here is an article you can find also all over the web. Trend lines are mathematically absurd. I also have a 17-minute video explaining it with lots of examples. So stop the video, read this, and see if you're more interested. If you want to find it anywhere on the web, just go to Google and type in trend lines absurd. Trend lines absurd. And the first 5 results will be different versions of my article, the video on YouTube, elsewhere. So check it out, especially if you disagree. All right, finally, here's a buddy of mine, Michael Harris. He's a quant. He helps traders and institutions, including hedge funds, design trading systems. He used to be, a very technical trader. He's very systematic and quantitative now in the way he mines data. This is a tweet from him yesterday, October 2nd. The smart sharks of Wall Street want traders to continue using random trading methods such as technical analysis. Why? Because random traders translate to profits. No random traders, little or no profits. What he's saying is that the traders who are using different charting techniques and switch from one to the next month to month or chase stocks, that brings money into the market that pros can take advantage of all day long. So the systematic trader eats the lunch of the non-systematic trader all day long. All right. Oh, a couple of Michael's books here. Michael Harris's books. One, Fooled by Technical Analysis, sort of a play on Nassim Taleb's Fooled by Randomness. The subtitle there is The Perils of Charting, Backtesting, and Data Mining. And his other book, 15 Lies About Trading and Investing. So Michael and I have been coming at this from similar paths, and he's much more quantitative and systematic than I am with the work that he does. But we've been coming at this same logic that the algos are way too fast, and all they do is exploit technical traders. And so it's technical analysis still works, but if all of your trades are based primarily on technical analysis, then you better be extremely disciplined and extremely systematic, or randomness will come back to haunt you. If you only take the trades that look good to your eyes and not follow a quantified system, then you will be lunch. All right, I think I covered everything I wanted to. This is the way technology is disrupting investing and trading, and you know, these trends are unstoppable right now. I think that the bull market will continue, and it pays to take advantage of these trends. I mean, look at Amazon. I said Amazon was a buy a year ago at $1,000 and at $1,200. But does that mean I bought it and stayed in it at on our way to 2,000 here? No, of course not. But money piling into the markets definitely will do something like that. I just saw that Jeff Bezos' wealth hit 160 billion, and that puts him over Bill Gates at number 2, and they had Bill Gates' wealth at 97 billion. So look at that gap, extreme gap between the number 1 and the number 2. This is what Taleb has written about for years. If you haven't read The Black Swan, you should. The tails are extremely fat when it comes to outsized wealth or luck. All right, thanks for joining me in the kitchen. We'll talk to you next week.